Hello and welcome to our section on monetary policy. In this section, we focus very heavily on how central banks operate. How do they go about their decisions to, cool an overall economy? How do they stimulate an overall economy? That will allow us to build a better picture on which way and which direction we feel the market will be going. So we will be discussing areas surrounding interest rates, open market operations, reserve requirements, how central banks use quantitative easing, looking into forward guidances as well as currency interventions. Finally, we'll focus on inflation and lender at last resort. All these areas will help us really analyze the central banks, how they go about it, how policymakers interpret data, and in turn should build a great picture for yourself on where you feel in the financial markets may possibly go, and in turn it will help you keep educating investors so that they feel and they got the confidence that you know exactly what you are doing, especially if they are to deposit capital with yourself. Okay, now we're going to kick this chapter off with just really discussing the key components of the central bank's monetary policies, and just touching on what we will be going through on each individual slide. So when we refer to monetary policy, this is the action undertaken by a nation's central bank. And when we talk about central bank, that could be the European Central Bank, that could be the Federal Reserve, that could be the Bank of England, or any other one of the multiple nations out there. And that is, they are designed to control a money supply, interest rates, in order to achieve their financial strategic goals, their macroeconomic goals. Let's put it that way. So that could be controlling inflation, managing employment levels, and stabilizing their own currency. Okay, but let's just break that down that bit further, just so we can really understand the array of objectives central banks may have and the role the monetary policy will play. So I've discussed price stability. One of the central bank's primary goals is to control inflation and prevent deflation. Okay, maintaining price stability helps preserve the purchasing power of the currency. So it could be the sterling, it could be the dollar, and it provides a predictable environment for businesses and consumers to make long-term economic decisions. Okay, ideally we want more purchasing power, not like over the last 3 years when we've had a huge amount of inflation. Our purchasing power has decreased. Okay, so the central banks can actually take decisions in order to bring down inflation, which we will be discussing as we go along. Now, full employment. Ideally, many central banks aim to promote maximum employment, meaning a level of employment where most people who want to work are able to find jobs. So when we say full employment or maximum employment, that doesn't mean everyone has a job. It is a certain percentage of eligible people. That's what would be classed as full employment. So central banks try to reduce unemployment levels through policies that encourage economic growth without sparking excessive inflation. So they try helping businesses, and if businesses are succeeding, they are opening the doors for new individuals to start work and in turn stimulate the overall economic growth. Okay, and that leads me to the next point. Central banks aim to support sustainable economic growth by providing a stable environment where businesses can invest and consumers can spend. Okay, and a lot of central banks' policies usually happen during slowdowns. Okay, or it could be a case of just cooling it down when we are growing too quickly. Interest rates are one of the biggest players or the biggest cards to deal when we are trying to deal with economic cycles. So managing interest rates is going to be a key part. Central banks aim to stabilize financial markets and encourage consistent borrowing and lending practices, which is crucial for not only business investments but also consumer spending. And if all is done efficiently, that will lead to financial stability. Okay, central banks aim to ensure that our financial system is stable, and there is no real risk of bank failures or financial crisis. Um, as much as you want to eradicate those risks, it cannot be eradicated. But central banks try to minimize it as much as possible. So they regulate financial institutions, they act as a lender of last resort, and intervene when necessary in order to maintain the trust in the banking system. So you and I are not in a position where we have to do a bank run, try getting out the pennies out of our bank, and so on. Okay. Exchange rate stability. Central banks also aim to stabilize the exchange rate of their own currency. Um, we want to make our currency strong, but still very much appealing at the same time. So, especially in economies highly dependent on international trade, a stable exchange rate can help control inflation and maintain that investor confidence without seeing unnecessary spikes. Um, that naturally leads to balance of payment stability. If a country is concerned about its balance of payments, which includes trade balances and capital flows, keeping these in check can prevent economic shocks and relying very much on external money to a certain degree. And the final part would be mitigating any sort of financial crisis. You know, in times of financial distress, central banks always act to provide liquidity to markets and institutions. They aim to prevent panic and restoring confidence in the city. This can involve a lot of emergency measures like being a lending facility or bailing out institutions and banks, in our case, in the '08 to 2010 crisis. So if everything is done properly and central banks monitor and manage cash flow and supply of money, ideally we'd be in a situation where we can ride any form of tidal wave. Okay. Now, um, there are couple of different ways of looking at monetary policy. There is expansionary and contractionary monetary policy. So when we talk about the expansionary part, this is a process of implementing policies to stimulate the economy by increasing money supply and lowering interest rates. Okay, naturally used during periods of recessions or economic downturns. If we look to contract the overall economy, it's aimed to reduce the money supply and increase interest rates, typically to control inflation. So used during periods of expansion like we've seen over the last 3 years in worldwide economies. Okay. What we're going to do now is just briefly touch on the areas we are going to be looking at. Okay, we will dedicate a slide each and go into a lot more detail. But the central bank has a number of options to their disposal. Central banks being the most obvious, central banks, they set the benchmark interest rate that is designed to influence borrowing costs for banks, businesses and consumers. Lower rates ideally stimulate the economy by encouraging borrowing and spending, while higher rates, slow down growth and bring down inflation as spending is reduced. Then you've got open market operations. This involves the buying and selling of government bonds, by the central bank to regulate money supply. If they're buying securities, it's a way of injecting money into the economy, so that's expansionary. If they are selling them, that reduces money supply, so that is contractionary. And the next one is reserve requirements. This is in essence is a minimum amount of reserves commercial banks must hold against deposits. So it's a minimum amount they have to set aside. Okay, they're not allowed to spend it. They're not allowed to invest it. It's an emergency fund. Okay, and it seemed to be quite popular. Then you've got QE, quantitative easing. This is a policy where central banks purchases long-term government bonds and other financial assets in order to inject liquidity into the economy, especially during times of very low interest rates. This increases the money supply and lowers long-term interest rates over time. Very popular QE asset purchasing programs during the '08 to 2010 recessions in order to free up banks, for banks to be refinanced, in essence, for them to start stimulating the economy once again. Now, forward guidance is important. Central banks and their monetary policy decisions are not always just focused on actions. It's also what they say. So central banks are important in providing communication. They are very diligent with it. They're very up to date with it, and they give us an indication of future direction of where they see monetary policy going. That could be based on maybe projections on interest rates, where they see inflation coming down or going up. Okay, where they may look to taper, stop asset purchases. Okay, so it's there to influence market expectations and economic behavior, but also being very transparent. Then you will have currency intervention. Central banks may intervene in the FX markets to stabilize or manipulate the value of their own currency. That could be a case of buying their own currency, selling their own currency. So another way of injecting supply or taking supply out. Okay. Then you've got inflation targeting. This is again goes hand in hand with forward guidance. Um, every central bank will have a specific inflation rate. Here in the UK, ideally we like 2%. Okay, and they will adjust their monetary policy tools to achieve that goal in order to ensure that they got that price stability. And then finally, they are a lender at last resort. Ideally, they don't want to get to this stage, but in times of distress, central banks do act as a last resort. They provide liquidity to banks or financial institutions which are facing short-term funding issues in order to prevent a systematic collapse of the overall market. Okay, so these tools are used in combination to balance economic growth, control inflation, and ensure that the financial stability is intact. So we will be discussing that in the next coming slides. Okay, we're now going to be discussing interest rates and why central banks use it as a monetary policy tool, and the effects for not only businesses but also consumers. So when we talk about interest rates, it can be seen in twofold. One can be the cost of borrowing money, how much you have to repay back, and the other will be the return on savings and investments if you keep it within a bank, for example. So when you borrow money from a bank or a financial institution, the interest rate is the percentage of the loan that you must pay back in addition to the principal amount, which is the amount you borrowed overall. And on the flip side of that, when you deposit money in a savings account, the interest rate is the percentage of the savings that the bank will pay to you by way of a return. You may hear two different phrases: nominal interest rate and real interest rate. Okay, but nominal interest rate, that's the more common one, is what central banks quote, and again what mortgage providers, for example, will quote. This is the rate that is actually set or observed in the market. It's not adjusted for inflation. The real interest rate, this is adjusted for inflation. It reflects the true cost of borrowing and the real return on savings. So in essence, that will be the nominal interest minus the inflation rate. So here in the UK, we've got interest rates at 5%, and then we've got inflation at 2.2. So if you were to subtract the two, the real interest rate will be 2.8% here in the UK. So that's one way of going about it. Now, how does interest rates affect the economy? Okay, I think this is going to be a key component. It's important because whichever way you look at it, it's always on the news. It's always going to be on, economic calendars. So it's important to really understand the effects that can allow you then to gauge where you feel that the economy may potentially go, how well central bank is controlling the supply of money, and then you can decide whether you want to go long, short, hedge, balance, whatever it may be. Okay, so the first one we will look at is borrowing cost. If we have higher interest rates, this makes borrowing more expensive. This will discourage businesses from investing and consumers from taking out loans, whether that be mortgages, looking for a new car, or credit cards. So higher interest rates is designed to slow down economic growth, to prevent overheating or high inflation. When interest rates are low, it makes borrowing a lot cheaper. It encourages businesses to invest in projects and consumers to spend. It stimulates economic activity. And especially if interest rates are low and businesses are doing well, they're more likely to want to maybe employ more people. So that can help employment levels. Government take more taxes, everything tends to grow. Okay. The next one we'll look into is the consumer spending aspect. Now, if we talk about high interest rates, borrowing becomes a lot more expensive, as we just touched on. Consumers are less likely to take out loans, less likely to want to buy the cars, appliances, go on vacation. So it can make it difficult. Credit card debt, it becomes a lot more costly to carry a credit card, so it could lead to reduced spending. Mortgage payments naturally, for existing or new homeowners, it will reduce your disposable income because you are now having to spend more money on mortgage payments. Now, when interest rates are low, which is ideal, borrowing becomes a lot more cheaper. It's there to encourage consumers to, finance their purchases through loans. Okay, personal loans, credit cards, and so forth. Mortgage rates fall, so your monthly payments are a lot lower. It frees up your income, allows you to go out and spend more. Okay, um, and again, it reduces the incentive to save. Encouraging people to spend rather than save is a way of central banks saying, look, no point putting in the bank. You're going to get no interest. You're going to get very little interest on your savings. Go out, maybe invest in the financial markets. Purchase stocks, invest in good tracker funds, for example. When we talk about investment decisions, if interest rates are high, for example, the cost of borrowing, even for businesses, rise, makes it a lot more expensive to finance new projects. Capital investments or expansion will be reduced. This could lead to a decline in business investments and fewer projects. They're not meeting their profitability threshold because they've got higher interest expenses. Risk-free investments such as government bonds become a lot more attractive as they offer higher returns. So always remember, um, when interest rates are high and the economy is slowing, investors tend to park their money into bonds because bonds will be providing quite an attractive yearly yield. It's also a safe haven. Your money's, you know, especially countries the likes of UK or the US, they're not going to default. So your money's safe. You will get your investment back, and you will get yearly or semi-annual returns, which is ideal. Now, when interest rates are low, um, businesses find it a lot cheaper to borrow, which is great. So for projects, expansion, or purchasing machinery, for example, it's a stimulus there to encourage businesses to keep growing and ideally get that job creation that they need. So investors may ideally then turn to riskier assets like stocks and properties or even venture capital investments in order to seek higher returns. As we mentioned earlier, safe havens wouldn't be necessary. Okay, because if the business sentiment is good, the economy is improving, people are happy to put risk on, they've got a lot more disposable income, so they're happy to invest in the stock market and housing, of course. So when we talk about the housing markets, um, we have touched on it, but when interest rates are high, making monthly mortgage payments become that bit more expensive. So a lot of people will second guess whether they want to buy new homes. Okay, so the demand for housing will fall. Okay, and that will affect the housing rates, building permit figures as well. Okay, eventually house prices will decline because there's not a huge demand. Okay, and that could obviously then re-energize the industry. When houses become cheaper, people are in a position to want to keep buying. But remember, I've mentioned this. If you watched any of my other slides, look, anyone that is cash rich tends to benefit from weak to declining economies. Okay, because if everything starts coming down in value, they tend to be the ones that profit the most out of it. But when interest rates are low, mortgage rates decrease, making home ownership a lot more affordable for a larger group of buyers, especially first-time buyers, and that will naturally then lead to an increase in housing demand and drive up housing prices, which is always good. Okay. And finally, inflation targeting. We will be talking about this in a little bit more detail, but central banks will raise interest rates to slow down the economy. This is if inflation is high. Higher borrowing costs can reduce consumer spending, as we know, as well as business investments. So cooling demand and putting downward pressure on prices is important if we are trying to reach our goal of 2%. But if inflation is too low, central banks can lower interest rates to stimulate the overall activity within the economy. Cheaper borrowing encourages more spending and investment. It boosts a lot of demand. It will send prices higher, moving inflation closer to its target. So, pretty much that is interest rates in a nutshell. Always get your head around rising and falling interest rates, what it's designed to do, and that will put you in a better position when you are looking to invest in the financial markets. Or it could just be for you to understand, when you always hear the news, why do they keep talking about interest rates? What are the potential effects of interest rates as well? Okay, now we will be discussing the open market operations, OMO. They are a key tool used by central banks globally in order to regulate money supply and influence interest rates. So this in essence involves buying and selling, in essence, government bonds in the open market with the goal of managing the liquidity and ensuring price stability within the overall economy. Now, anyone that's gone and already listened to my quantitative easing slide, there are a lot of similarities naturally by the way of asset purchases, but the goals are completely different, and that's something I will touch on a little bit later. So first, let's focus on buying government bonds. The focus on expanding the economy. So what the central bank does is it buys government securities from banks and other financial institutions in order to inject money into the financial system as a whole. So this will increase money supply, making more funds available to the banks in order for them to lend out and allow you and I to get housing, get loans, buy new cars if we need. Okay. As a result, interest rates typically tend to fall, encouraging borrowing and investment. So, this is definitely used during periods of low growth or periods of deflation, if we ever experience it, in order to stimulate the overall economy. So on the flip side of that, you will naturally have the contractionary method, when the central bank sells their own government securities, ineffectively removing money from the financial system. So it's reducing the supply of available funds. This is typically it typically causes interest rates to rise, making borrowing that bit more expensive, and in turn slowing down economic activity. So central banks will use this in order to combat inflation, as you know now, to cool down an overheating economy. So we'll touch on now, what are the main aims of, open market operations. The biggest one will be influencing short-term interest rates. Okay, not necessarily long-term interest rate. It's looking to directly affect the short-term rates in the economy. Okay, so by influencing these rates, central banks can, indirectly affect long-term rates, consumer spending, as well as investment levels. Controlling money supply, that goes hand in hand. So central banks will use it to control how much money is in the economy, how much money they want to take out of the economy. Okay, so increasing the money supply, as we know, encourages economic activity, whilst reducing money supply slows inflationary pressure by slowing down demand. And overall, it is designed to stabilize an economy. Open market operations are very flexible, very frequently used to stabilize any economy globally, okay, by making sure liquidity in the financial system is there during times of stress, or adjusting any form of monetary conditions to avoid anything drastic. So if we were to put everything we've just discussed in an example, let's say if inflation is rising, the BOE, Bank of England, might sell government bonds to reduce the money supply. Okay, who do they sell it to? They sell it to big banks, financial institutions. So it's making borrowing that bit more expensive, reducing consumer spending. But on the flip side, during a recession, it might buy the bonds back from not from the central banks. Central banks will buy bonds from the banks and other institutions, and that will then inject money into the economy, lowering interest rates in the near term and stimulating borrowing and investment. So it's an essential part of a central bank strategy to manage the overall economy. Now, I did discuss earlier, the similarities between um, open market operations and QE, because they are both a way of injecting money into the economy. But when we talk about open market operation, these are seen as regular targeted actions at controlling short-term interest rates, okay, and managing liquidity. Whilst QE is more of a crisis response, okay. It's used when standard things like basic open market operations or interest rates are insufficient, you know. So it involves large scale purchases of long-term assets to stimulate the economy. Okay, so remember, OMO is more regular, it's targeted, whilst a QE is designed for only being implemented when times are really bad. Okay, and they are large scale purchases of long-term assets. So in a nutshell, that is OMOs, and yeah, it works very much hand in hand with QE, but do understand the differences and understand why they are implemented. Okay, reserve requirements. Now, when discussing reserve requirements, it is a crucial monetary policy tool. Central banks, in essence, impose commercial banks to hold a certain amount of capital on deposit, either in cash or deposit those funds with the central bank. Okay, the amount is known as the reserve. So whatever money the central banks require the commercial banks to hold, that money cannot be loaned out, it cannot be invested, and is intended to ensure that banks have enough liquidity to meet any withdrawal demands, okay, from their customers. It's there just to help manage the overall financial system. It is also designed to affect money supply in the economy, interest rates, and overall activity. So whenever you hear reserve requirements on the news, just remember the central banks impose a policy with all commercial banks that they must hold a certain percentage of capital on deposit and they cannot touch it. Okay, just in case things go really bad, the stability of the financial system is important, and by putting the reserve in place, banks know that they've got an X amount that they can rely on at a certain point in time. Okay, so when we look at the purpose of having this requirement, well, I think it's fairly obvious. Financial stability is the most important thing. It ensures that banks maintain a minimum level of reserve. It helps them remain solvent and meet any form of financial obligations it may have. If a bank experiences a sudden surge in withdrawals, such as a bank run, having a reserve requirement reduces the risk of insolvency and reassures depositors that the bank can cover withdrawals. Okay, because let's be honest about it, if there isn't a reserve in place and a bank is looking to go under, it's usually the requirement of the government central banks to come and help bail out these banks, and so that's what they want to try avoid doing. Um, Another one is to control the money supply. Remember, reserve requirements directly influence how much money banks can lend out. When banks lend more, it increases the money supply as loans generate new deposits. Okay, so on the flip side of that, when banks hold more in reserve, so they got a larger amount in reserves, they have less to lend. This reduces the money supply. So by adjusting the reserve requirements, central banks can either tighten or loosen the liquidity in the financial system. This is to influence economic growth or really combat inflation. And probably the most important component would be risk management. The reserve requirement serves as a buffer for banks to absorb potential shocks or losses. It helps them mitigate risk in the banking sector, and so by holding reserves, banks have that safety net just in case there are some unforeseen, financial disturbances that may occur. Now, there are two components when it comes to reserve requirements. There are the required ones, and there is the excess one. So we'll discuss the required first. Um, when we talk about required reserve amounts, this is a minimum amount of funds that a bank must hold in reserve. This is mandated by the central bank. Okay, no negotiations here. These required reserves are calculated as a percentage of the bank's overall deposit liabilities. Okay, so it could be a percentage. It could be a 10% reserve requirement. So, for example, if the bank has 100 million in deposits, the bank must hold at least 10 million in reserve, and they cannot lend that money out. On the flip side of that, you've got excess reserve. Any reserves held by a bank beyond the required amount are considered to be an excess reserve. So banks may choose to hold extra amount to manage any other form of liquidity risk or prepare for unexpected deposit withdrawals. Okay, or because lending opportunities are weak. So if, for example, the requirement was 10 million, and they decide to hold 12 million in reserve, okay, they've got an additional 2 million, which is going to be considered as excess reserves. Okay, it does provide further confidence, but again, it is another way of banks controlling their own money supply as well. So with reserve requirements being a strong monetary policy tool, let's see, how they go about it. Okay, one could be to stimulate economic activity. If the central bank wants to, and remember when we talk about central banks, that could be the ECB, it could be the Fed, it could be here the Bank of England. Okay, if they want to stimulate the economy, it can lower the reserve requirements. So instead of holding, in our previous example, 10 million in reserve, they say you only have to hold 8 million in reserve now. So the lower reserve requirements means that the banks have to hold less money in reserve, and they can lend out a greater portion of their deposits. This increases the money supply, potentially reduces interest rates, and encourages borrowing, investment, as well as spending. Okay, they naturally implement this sort of policy during a recession or any economic slowdown to boost economic activity. And on the flip side of that, they can use reserve requirements to curb inflation or slow down the economy. Okay, so if central banks want to control inflation or slow everything down, as we may have an overheating economy, it can raise the reserve requirements. So instead of having 10 million required reserves, they could say you now have to have 15 million required reserves. Okay, a higher reserve requirement means that banks must hold a greater portion of their deposits, and thus, leaving less money to lend out. This reduces money supply, increase interest rates, and restrains economic growth. It'll cool everyone down, stop everyone spending, and in turn, hopefully look to bring down prices. And I'm sure many have experienced over the last 3 years. Okay, and the next and final one will be the impact on liquidity and financial stability. Okay, reserve requirements ensures that banks have sufficient liquidity to meet their customers' demands for withdrawals and obligations. So if banks were allowed to lend out all of their deposits, they may face liquidity shortages in times of withdrawal demand. Okay, so it's an important fact, and it's something we experienced definitely between 08, 09, 2010 when we had the financial crash, a big old banking crisis. So it's important that liquidity is maintained within the financial system, and also maintaining that trust within the banking system. If depositors believe that the banks do not have enough liquid assets, it can lead to panic and can lead to bank runs, and where they all rush and they all try taking the money out all at once. So it's never great. Finally, financial stability. Okay, by requiring banks to hold reserve, central banks have created a buffer against any form of financial instability. Um, so it's a big form of risk management. So always keep that on the top of your mind. Now, with regards to global variations, look, each region will react differently to reserve requirements. There's no steadfast rule on how everything works. Within the European Union, for example, I believe reserve requirements could be around even just 1%. Okay, they like the banks to be liquid. They like to promote economic activity and promote lending. So that's one thing to be very aware of. I'm not fully aware of, how, for example, the Fed go about it. It does vary, but it's important if it is something you want to look more into. It's probably worth delving into. But the reason why you want to know about reserve requirements is to really understand the long-term health of an economy. If you are speaking to investors, if you are looking to bring on board clients, you need to fill them with a lot of optimism, okay, and security about the current financial climate. So understanding monetary policy decisions is important. Is interest rates coming down? How are they managing reserve requirements? Okay, what is the outlook for the next 6 to 12 months? Again, if it's not, booming and the economy is not doing as well as we expect, you want to put ideas and strategies in investors' minds where you can benefit, where you can hedge their investment portfolios, take advantage of a potential falling market, look at defensive stocks, look at value stocks that can provide income and returns during uncertainty. Okay, but understanding reserve requirements and every other form of monetary policy decision will help you understand policymakers' minds that bit better. Okay, now we're going to take a closer look at QE, quantitative easing. It is a monetary policy tool used by central banks to stimulate the economy, especially when traditional policy measures such as lowering short-term interest rates have become somewhat ineffective. Okay, so QE involves a large-scale purchase of financial assets, typically government bonds from the open market. The most common form is, or you may hear it around quite a bit, is the asset purchase program or just asset purchases in general. This is when central banks purchases a significant amount of government bonds or other financial assets from banks and other financial institutions. The reason is to increase the money supply and inject liquidity back into the financial system. Okay, so central banks may create new money electronically to pay for the new purchased assets. This can increase the reserve of the banking system. So always remember, banks naturally buy government bonds themselves, okay, due to the fact they get interest yearly and so forth. But when the central banks come and they buy back the bonds, okay, they in essence have refinanced the banks. The banks now have all that money back in their pockets, and so by them having enough money back in their pockets, they can start giving out loans, mortgages, helping small business, and really stimulate the economy. Watch the economy grow once again, get people out there spending. So that's the primary reason of asset purchasing or the QE program. And I touched on this, increased reserves. By purchasing assets, central banks increase the reserves held by commercial banks. As mentioned, it boosts lending and investment by providing banks with enough reserves that they can go out there and extend credit to whoever they would like. Okay, one of the long-term effects is ideally QE can play a part in lowering long-term interest rates. Okay, by increasing demand for bonds and other assets, this naturally drives up their prices, lower yields, and that naturally helps encourage borrowing and investment in long-term assets such as corporate bonds, going out there buying more houses and really just stimulate the overall activity. So whenever we talk about the impact of lowering long-term interest rates, you're lowering the overall cost for businesses and households. That is the main aim. Then that's going to naturally spur, consumer spending, people going out, buying new houses, setting up new businesses. So that's why QE is essential for lowering long-term interest rates. That's if interest rates are high in the first place. The next one would be supporting asset prices. Um, you know, QE can be designed to support prices by increasing demand for various financial assets such as stocks, bonds, real estate. Okay, because remember, when QE is introduced, it is designed to stimulate the overall economy, and that then increases demand. Risk becomes that bit more prevalent. We're happy to now start investing in the stock market. Okay, we're happy to start, buying more growth stocks. Watching the markets rally. Um, a lot of the reasons QER has been designed and is in place is to prevent a collapse in asset prices during periods of recession, any type of distress, or any form of instability. It's that extra layer of support. You know, so rising asset prices can, improve household wealth, consumer confidence, lending, and those are all good parts about what QE is designed to do. Now, banks naturally enjoy asset purchases. They enjoy QE. They like money being, flooded into the market. But it's not only to enhance confidence of banks, but also for individuals. QE signals a commitment by the central bank to support the economy and ensure, financial stability. By boosting confidence amongst investors, businesses, and consumers, will encourage them to engage in the economic activities and start going out there and spending their money. So it could lead to higher investments. It could lead to companies hiring more, bigger consumer spending, and it contributes to the overall recovery and growth of an economy. Now, the big problem will be an exit strategy. Okay, as you're well aware, you just can't keep flooding, the institutions with money. Can lead to natural inflation. So the exit strategy is somewhat outlined initially, but if you are keeping up to date with policymakers, they will give you updates on it. There's not a huge amount of QE, especially when this video is coming out, of flooding the markets. A lot of it is during a lot of hardship, but an extra exit strategy is designed to really unwind or taper their program. Okay, so as the economy improves, they will start to taper their program. So, in order to prevent any form of inflationary pressure or asset bubbles, central banks will start to say month after month, we are going to buy less assets from banks and institutions. They want those institutions to start, standing on their own 2 feet. Okay, so they'll sell the assets back in the market, or they'll increase interest rates in order to control everything. Okay, but tapering is the most common form. It's just gradually slowing down asset purchases without having any massive shock. Okay, but wording is a big part as well. Remember, if central banks come out with very, harsh and aggressive wording, they're going to stop QE immediately, or this will happen, it can frighten the market. Investors will start to sell stocks. Okay, but remember, QE can only stop, any of these monetary policies can only stop or slow down if we're starting to see economic growth. Okay, and that economic growth is only seen in our financial calendars. We need to see more jobs being created. We need to see less people being or claiming unemployment. Consumer confidence figures, PMI figures need to be increasing. Overall, the economy needs to be improving for the central banks to be saying, okay, fine, we're recovered very well. Now we're going to start tapering our QE program. Okay, so those are the main reasons why QE would come to a halt. Now, if we talk about real-world examples of QE, I've been fortunate or unfortunate, whichever way you want to put it, to be part of most of these scenarios. I started out when the '08 financial crisis happened, and we subsequently had economic meltdown globally. So it was a massive, large-scale purchase of treasury securities, mortgage-backed securities. That was one of the biggest effects. Especially that's what the Fed put in place. The ECB did very much the same thing. Um, and remember, over here in Europe, it was slightly different. It was not only companies going bust, it was also governments and economies going bust. The likes of Greece, Ireland, Italy, Spain, Portugal, they were very much on their knees and required bailouts and so forth. So, just to conclude, QE is a powerful tool. It's designed to address a lot of economic challenges, stimulate growth, and get away from the traditional forms of monetary policy, such as lowering short-term interest rates. So yeah, that's QE in a nutshell. Not a huge amount more you need to know, but if there are anything else you need to know, just write them in the comments, and I'll be happy to answer them. Okay, now we're going to look into a bit more detail on the pros and the cons of quantitative easing. Okay, it's important to understand areas where the policy works and areas where it doesn't. Okay, so just to refresh our mind, central banks use QE to stimulate the economy when regular methods such as lowering short-term interest rates are either not effective or become less effective. Okay, we'll focus very much on the pros to begin with. Okay, so first and foremost, stimulating economic growth. Okay, I think that everyone knows where we're going with this one. By purchasing government bonds and other financial assets, QE is designed to inject liquidity into the financial system. Okay, in the long term, this does lower interest rates, making borrowing a lot cheaper and encouraging businesses to invest and go out there and spend. So it does help spur economic growth. It helps in fighting deflation. QE can help prevent a persistent decline in prices, which could lead to a downward economic spiral. So by increasing the money supply and stimulating demand, QE pushes up prices and inflation, helping to avoid or combat, any severe deflationary pressures. Supporting unemployment, with lower borrowing costs, companies may be more likely to invest in expansion and hiring. Increased business activity can lead to higher demand for, labor, supporting job creation and reducing unemployment during, periods of stagnation. So remember, the byproduct of, QE, yes, is the initial purchase of bonds, but what happens after that? Well, if people are out there spending, companies are growing, and so they are looking to expand. It can support in employment and other areas within business. And next of all, it will promote market confidence. If you know that your central bank is committed to supporting the economy, investor confidence is going to be very high. Okay, especially if you're investing in the markets and we're now starting to see an upturn in the economy, the stock market's rallying. If the central bank continues along its monetary policy route, that money's going to always be injected. And of course, we'll come on to the cons in a bit, because when they do start slowing it down or stopping it, we can see investor confidence wane somewhat. But in the initial term, investor confidence is good. That's naturally when you see, during a recession, very deep recession, let's put it that way, and we start coming out of it, or even during the pandemic when the markets collapsed, everything rallied due to the fact that central banks were, lowering interest rates to, support the economy. They were doing furlough schemes. They were doing everything to pump money back into the economy, stimulate growth, get businesses hiring again. Okay. And the next one will be market liquidity. By purchasing assets, central banks increase the liquidity in the markets. This helps ensure that the bank and other financial institutions have enough capital to keep lending, keeping the financial system running smoothly, even during times of, distress. Let's put it that way. And finally, currency depreciation. I've put it as a pro, okay, because it can help. Of course, you don't want your currency to be depreciated to a level where everything becomes cheap and you're not actually growing. But QE often does lead to a depreciation of the domestic currency, whether that's here in the UK or the US. This is on the basis of if you are increasing the money supply, it does lower the value of the overall currency. A weaker currency can make exports a lot cheaper and a lot more competitive in the global market. So that can boost demand for domestic goods and, services as well. Okay, so this does help support the overall economic growth. So, those are a lot of the main pros attached to it. So, um, while QE is a powerful tool for addressing certain economic challenges, it's not without its risks, okay, such as inflation, asset bubbles. Um, but in times of distress, it can have its significant benefits, okay, so that's one thing to keep a close eye out on. But let's have a look at the flip side of it. Let's see what are the cons attached to QE. Okay, one could be asset price bubbles. Look, by injecting a large amount of liquidity into the financial system, QE can lead to excessive risk taking. As investors will maybe look to seek higher returns. This can inflate, assets such as stocks, property, happens quite a lot, beyond their fundamental values. So when we say before their true value, so this creates a bubble that may eventually burst, leading to market instability or worst case crashes. Okay, as mentioned, look, if you know that the economy and the banking system is supported adequately with a lot of money, investors are very much risk on. Okay, and if the banks have more money, they're more likely to issue mortgages and loans with lower interest rates. So you're more likely to take that risk. And then, asset bubbles will come if a huge amount of demand for certain properties. And then again, eventually, if they can't pay for these properties and mortgages start to default, you could see the whole banking, or you could see a whole, property crisis, which we saw in our initial '08 to 2010 recession, which was quite severe. You can have income inequality. Okay, so QE tends to be disproportionate in its outlook. It benefits those who own financial assets such as stocks, real estate, as these asset prices tend to rise with increased liquidity. Wealthy individuals are more likely to hold such assets, whilst if you are slightly lower in the pay gap, you are more likely just to be focusing on surviving at that time. Like they always say, cash is king. Anyone with a huge amount of cash is more likely to benefit from a load of uncertainty and distress. It's the nature of the beast, unfortunately. You can get distorted market signals. This goes very much to asset bubbles. By artificially, lowering interest rates and influencing asset prices, QE can distort market signals. Investors may struggle to accurately really assess the current conditions because everything may look good, but they're not looking deep enough to realize their investment decisions are based on either poor signals or misguided data. So could really lead to inefficient capital allocation. Or the next point will be limited impact on the real economy. Now, while QE may boost financial markets, its direct impact on the broader economy can be limited. Banks, for example, they may not pass on the benefits of QE in the form of increased lending to consumers and businesses. So that results in less stimulus in the real economy. It's very rare for this to happen, but we see it with savings. Okay, inflation is naturally supposed to benefit savers, but again, banks don't pass on that benefit to savers until a long way down the line. But as soon as inflation figures come out, they're very quick to put up mortgage prices. Okay, demand more every month. But when it comes to savers, they're very slow to pass on that benefit. Exit challenges, like exiting from QE, when they stop buying assets and eventually sell them off can be very tricky. Okay, if not carefully managed, it can cause interest rates to spike, leading to a lot of turbulence. Okay, investors may not feel the economy is ready to stand on its own 2 feet. But remember, the central banks won't make this won't exit QE unless everything is in line, where they feel that uh, confidence is high, markets are strong, uh, employment data is good, unemployment data is coming down. So all these factors, but you got to remember, investors are very emotional. We take everything bad. Okay, that's probably the best way to look at it. So exit challenges can be quite difficult. The central bank's balance sheet risk. Okay, QE greatly expands the balance sheet by accumulating large amount of financial assets, which are government bonds. So if the value of these assets falls significantly, it would lead to losses for the central bank, which may undermine its financial position and credibility. Okay, it's all good buying something at one price in order to stimulate the economy, but when you try selling it back in the open market and it's not valued the same, you are taking a financial hit. Okay, there are global spillover effects. Um, you know, in major economies like the US or Europe, um, it can affect emerging markets and the overall financial system. For example, if QE-driven capital flows can destabilize currency values. Okay, prolonged um, destabilization of currency values is bad. It could lead to inflationary pressures in other countries, causing uh, dislocation globally. Okay, so remember, it's not just the US and Europe. How they remember, we'll always listen to what's coming out of the US by way of data and information. That will naturally affect us, obviously not rapidly, but but emerging markets can be, you know, blown out of kilt very quickly on decisions coming out of the big central banks globally. Um, Dependency on central bank support. Look, over time, markets and economies may become overly reliant on central bank intervention. You know, reducing incentives for governments to implement, new fiscal or structural reforms. So they are more dependent on central banks to say, look, you know what, more QE, lower interest rates. You know, once you become that dependent, the economy is not growing naturally, and again, you can get a lot of distorted data. Everything may not be the value that it actually is. Okay, so those are predominantly the cons attached to QE. Um, Hopefully that adds some value and help to you. But remember, when you are speaking to your clients, be fully aware of the pros and the cons. Understand if QE is being implemented, what are the exit strategies, how may the markets react to it, where are the opportunities. Because remember, if more money is being flooded into the market, investor confidence tends to be high. So you may want to take advantage of, growth companies, high beta companies, as they tend to do very well. But if there is going to be some form of an exit strategy where QE is going to start to be tapered, you may then want to look for an exit strategy yourself, or position your portfolio maybe more defensive if you feel the market will go that way. No guarantee it will. Markets do nothing but rally. We have the odd pullback, but we always keep hitting all-time highs, so be very conscious of that. Okay, now we're going to focus on currency interventions, also known as foreign exchange interventions. They go hand in hand. These are actions taken by central banks in order to influence the value of their own currency in the broader FX market. So here in the UK, we'll talk sterling for these examples. Okay, so the Bank of England will influence the value of sterling. Okay, so why they may do this is, part of a broader monetary policy goal, which may be destabilize the currency, avoid volatility, adjust for inflation levels, support, broader objectives, which could be promoting exports and managing imports better. Okay, so, central banks do intervene when we talk about their objective, and that would be to prevent making sure sterling is not massively depreciated or massively appreciating, which makes us less competitive in the broader market. Okay, and now we'll look into the types of interventions that do exist. Let's say, for example, the central bank wants to depreciate sterling, for example. So the Bank of England wants to depreciate sterling. You may ask, why would they want to do that? It could be designed to make exports cheaper and boost domestic economic growth. So in turn, what it will do is it will buy foreign currencies, it'll buy dollar, it will buy euros, and it will sell whatever quantity it has of sterling, okay, in the main FX market. So what happens is by increasing the supply of the domestic currency, its value will fall. It's a supply and demand tactic. Remember, if the central bank starts selling huge amounts of sterling and there's not a huge demand for it, okay, the value of that will go down. Okay, and remember, whenever we talk about wanting to uh, depreciate our currency, it is a big part of exports. If it's cheaper to buy goods from here in the UK, that will be brilliant. It will boost our exports. Domestic growth will go through the roof. Okay, and that's one of the main aims in order to remain competitive, especially in this trading world, which is heavily competitive. Switzerland do it quite actively in the currency market for years in order to prevent the Swiss franc from appreciating too much. They start selling large quantities of Swiss francs, and they start buying a huge amount of dollars. Okay, remember, if the Swiss franc is so expensive, it makes me less likely to want to buy goods from that nation. Okay, I would rather go to maybe the UK or the US where it's cheaper to buy it. Okay, and by us going elsewhere to buy our goods, it's naturally going to hurt the overall Switzerland economy. Okay, so what they try to do is try depreciating their currency to a level which is in line literally with the broader market. Another way would be to appreciate the national currency, okay, in order for sterling to go up. Okay, they may want to do this in order to fight inflation by reducing the cost of imports. Okay, so by the central banks, by their aim of wanting to control inflation, they will, in essence, sell foreign currency. So they'll start selling the dollar, they'll start selling euros, and they'll continue to buy sterling. This then reduces the supply because we're taking sterling out of the market, we're reducing the supply. Okay, demand is still very, very much there, causing the price to appreciate. Okay, and by less people buying goods from the UK, it is slowing down growth, and inflation will in turn look to get that bit lower. Okay, so whenever you're looking at currency intervention, always focus on the supply and demand factor. Why are the currencies why are central banks looking to depreciate their currency? Well, they will depreciate their currency simply by buying foreign currency and selling their own domestic currency. This will help exports. It'll be cheaper to buy from that country, okay, and their growth will in turn go up. But if we look at economies and central banks looking to appreciate their currency, they in turn are buying back their domestic currency and selling foreign currency, okay, and that will in turn allow for their currency to appreciate. It may become less attractive, so exports may come down, and in turn inflation will come down due to the lack of demand. So that's the way we tend to look at currency interventions and how it's interpreted in the broader market. There are a number of challenges and risks associated with currency interventions. One will be its effectiveness. Like when it comes to currency interventions, the majority of the time they tend to be temporary. Market forces eventually will overpower the central bank's actions, especially if the intervention goes against the broader economic trend. Okay, so you may get a short-term gain from it, but it's not a long-term play. Foreign reserves depletion. Remember, central banks all around the globe have a huge, predominantly dollar. Okay, they stockpile dollar. Okay, by intervening to support a currency by selling off a lot of your foreign reserves can deplete the country's reserves overall, limiting its ability to continue interventions in the long term. Okay, so that's why it's more of a temporary situation. And remember, a lot of trade is done in dollars, so the last thing you want to be doing is getting rid of your stockpile. It can create trade tension. Your countries that are actively, weakening their currency may be accused of currency manipulation. This can lead to trade tensions and retaliatory actions, okay, from your trading partners. It is very common with the US and China. US always criticize China for keeping the yuan undervalued in order to boost its exports. Okay, the yuan isn't monitored as rigorously as, for example, sterling, dollar, all the majors, as well as some of the minors, in fact. So, um, you know, trade wars come off the back of that. Okay. Sanctions come off the back of it. Okay. So these are things to keep a very close eye on when looking at how how central banks intervene when it comes to currencies. Okay, now we're going to continue our understanding of currency interventions and, you know, the tools that are used as well as the motivations behind it. Okay, a lot of this will be areas you may have covered on our FX or our foreign exchange section. But just to recap, currency interventions are carried out by central banks in order to influence the value of their own currency in relation to the wider FX market. Several tools are used. The more prominent one is the foreign exchange reserves. Okay, when we talk about the foreign exchange reserves, these are traditionally, foreign currencies, not just their own currency. It can be gold as well as other financial assets which the central bank holds. So these reserves are used to buy and sell, the national currency in the FX markets. So central banks will use their reserves to either buy domestic currency when it's depreciating, or to sell domestic currency when it's appreciating. Okay, and don't forget, as I will continue to mention, dollar is the widest used currency out there. Every country in the world has a large amount of reserves of dollar, so that tends to be one of their main bargaining tools. Spot transactions, and you probably come across this when we're talking about FX markets or foreign exchange trading. So a spot transaction really involves the immediate purchase and sale of foreign currency in the open market. So it's typically settled within 2 business days, but it will show as immediate on your screen. So yeah, central banks will use spot transactions to quickly adjust the value of their currency, especially if they want to quickly strengthen its currency, if there's been some form of a shock. Okay, so yeah, so central banks will want to strengthen the pound. It will sell US dollar if it wants, or it will continue to buy pound as well. Forward transactions, now these are in essence an agreement to buy or sell a certain currency at a future date at a predetermined price. Okay, unlike spot transactions which are settled immediately, these are now settled at a future date. Okay, so forward transactions allow central banks to really influence the future exchange rate, if you must, without making any immediate moves. This can stabilize currency expectation, influence long-term trends within the FX market as well. And then finally, you will have FX currency swaps. Okay, a currency swap involves the exchange of one currency for another between two parties. Okay, often between central banks. So it could be between the Bank of England and the Federal Reserve over in the US, with a agreement, to reserve a certain amount of currency at a certain price in a future date. Okay, so they're often used to provide liquidity in the markets without selling off a huge amount of reserves, or just to influence the exchange rate over a specific period of time. So these tend to be the more common ways in which currency interventions are used, and yeah, how they traditionally tend to go about it. Now, what are the motivations behind these form of interventions? Okay, as mentioned in the previous slide, it could be down to promote export competitiveness. Weaker national currency makes exports cheaper and a lot more competitive in the global market. Okay, when a country's currency appreciates too much, it can actually harm its exports by making their goods look more expensive abroad. Okay, it could be destabilize the currency. You know, excessive volatility in the currency can lead to uncertainty in trade and investment. So central banks may intervene to stabilize their currency value, reduce fluctuations, and really get back into a more predictable economic environment. Look, Brexit for us was a big milestone and a big flash crash in the market. Currency intervention at that time was also used as well as everyone just buying the dip and then making their profits on the way up. Addressing any trade imbalances. This goes hand in hand with my first point. Really, currency interventions can help correct imbalances within trade by adjusting their exchange rate to encourage exports, discourage imports, whichever way you look at it. A weaker currency can boost exports, as we know, and it will help the overall trade deficit, especially for countries within that sort of remit. And finally, countering any form of uh, depreciation, especially excessive depreciation. When it depreciates rapidly, it can lead to inflation and the loss of confidence in the economy. So central banks can intervene to prevent, a currency collapsing way too much, either just by selling off their reserves they've got in other currencies, or just keep buying, in our case, sterling, in order to strengthen it. But in a nutshell, that is currency interventions as a whole. And yes, please review both sides, as I feel we've covered every point to the best of our ability, and it will help you in your road to whether it's bringing on board investors or just understanding the markets and the currency markets that bit better. Okay, now what I've done here is I've put together a quick slide on the positive and the negatives associated with currency interventions. Thought it'd be wise just to put everything we've discussed all in one little slide, so it's a great reference point if you need it. So the first one will be exchange rate stability. By intervening in the forex market, central banks can reduce exchange rate volatility. This provides a lot more certainty for businesses, especially those that are engaged in international trade and investment. So overall, stability in the currency market does support and smooth out the overall functioning of the country's economy. Okay, the next one will be export competitiveness. Weaker currencies make exports that bit more cheaper and a lot more competitive in the foreign market. So it can boost demand for domestically produced goods. So this is particularly beneficial for economies that really rely heavily on their exports. Okay. Inflation management. Currency interventions can help central banks control inflation by influencing the cost of what imports. Okay, a stronger currency, as we know, makes imports cheaper. It does reduce a lot of inflationary pressure, whilst a weak currency may boost inflation if it is too low, that is, as we will see an increase in import prices. The next one would be preserving economic stability. Now, interventions can reduce economic disruptions caused by any sudden exchange rate fluctuations. So a stable currency does help foster, long-term investments, as businesses can make decisions without having to fear about, sharp currency movements that can erode their profits. So remember, businesses always take a 6 to 12-month view. So knowing that currency is going to be stable within your home region, that is going to be vital. Addressing any form of speculative markets. Now, in times of crisis or a speculative attack on currency, interventions can prevent any sharp devaluations and really restore market confidence. So, by propping up currency, central banks can discourage speculative movements and prevent, a self-reinforcing cycle in order to prevent any form of depreciation. Financing or enhancing investor confidence. Now, consistent and effective currency interventions can boost investors' confidence by just really demonstrating that the central bank is committed to maintaining a stable economic environment, and this in turn will attract foreign investment and capital inflows. Okay, and finally, we are looking at boosting economic growth. By keeping your currency competitive, any form of intervention can stimulate any economic growth by fostering greater export demand and investment. So when exports, increase due to a weaker, not necessarily weak currency, a weaker currency, domestic industries can grow, leading to ideally higher levels of employment and a lot more economic activity. So in a nutshell, those are the positives attached with, central banks' decision to do currency interventions. Now we will take a quick look at the negatives of any form of monetary policy on interventions. The first one will be any distorted markets. If you get frequent currency intervention, it can distort market signals, leading to mispricing of currencies and efficient allocation of resources. Okay, this can then reduce the overall effectiveness of the market in determining exchange rates, based on economic fundamentals such as inflation, productivity, interest rates. So, overusing this can actually have a knock-on effect. Market participants may begin to anticipate these interventions, creating somewhat of an artificial demand or supply, leading to a lot more speculative behavior rather than natural market adjustments where the market reacts to official data. But if there's always going to be either buying or selling of currency every time, things get a little bit tricky. It's going to lead to a lot of mispricing. Depletion of foreign reserves, to do any form of intervention, central banks will use their foreign exchange reserves. Sustained efforts to keep propping up the currency or weakening it can lead to rapid depletion of reserves, leaving the country a lot more vulnerable to external shocks and limiting its ability to make any other continued interventions. Risk of speculative attacks. Now, if the market participants like you and I or banks believe that the central bank will be unable to maintain an exchange rate, they may speculate against the currency, causing massive capital outflows. That's a big concern if you've got all the big traders just literally shorting your currency or selling large quantities of the currency. And again, if the central bank runs out of its reserves, it may have to abandon any intervention efforts, leading to rapid depreciation of the currency. Unintended consequences. Now, there are side effects associated with any form of currency interventions that are not intended by the policymakers. For example, artificially low exchange rates may lead to inflationary pressures, and in turn making imports more expensive. Or interventions to strengthen the currency might actually hurt export competitiveness. This can reduce the economic growth or really destabilize prices, especially if the interventions are misaligned, misjudged with the broader economic conditions. Okay. Trade tensions, we discussed this in our previous slides. If a country's intervention is seen as a way of unfairly devaluing its own currency to promote exports, it could lead to trade disputes, especially with competitive nations, especially those that may be suffering a trade deficit. They may feel like it's a little bit unfair. Why shouldn't we do that? I have mentioned US often accuse China of manipulating its currency to keep the yuan undervalued, and that leads to trade tensions between the two countries, and imposing tariffs and other economic retaliatory measures can actually hinder relations in the long haul. The next one will be limited impact on the real economy. Now, this is a scary one. Look, in some cases, currency interventions really just fail to influence broader economic conditions, especially if the underlying cause of the currency weakness is down to poor economic fundamentals or political instability. If those issues are not addressed, interventions will only provide somewhat of a temporary relief, but not a long-term solution. So, currency interventions alone are not a substitute for, proper fiscal and economic policies. Without reform in these areas, you know, any form of intervention will just be short-lived, and the long-term effects are something we're still going to have to address. The next one will be over-reliance on interventions. You know, over time, a country may become too dependent on using currency interventions to manage any form of economic problems, neglecting more substantial solutions like addressing productivity, enhancing governance, or really diversifying the overall economy. Okay, so over reliance can lead to a very vicious cycle where the economy becomes too dependent, investors and business become too dependent, um, and again, it could just lead to a lack of confidence. Okay, and the next one is pretty much goes hand in hand. It's a loss of credibility. If central banks intervene frequently without success, or they have very limited effect, um, you know, they can suffer a loss of credibility by businesses, investors, banks. So once people start doubting central bank's commitment or its ability to maintain its currency targets, future interventions become, less effective. So, in a nutshell, those are the pros and the cons of um, why currency interventions work very well, and the side effects and why it doesn't work so well in certain regions. So yeah, please take note of them, and yeah, if there's any questions, just try going over the slides. I believe we have covered as much as possible, or at least everything that you need to know. Okay, now we're going to focus on inflation targeting. It is a monetary policy tool where the central bank will aim to keep inflation within a specified target range or a set level over a period of time. So here in the UK, we ideally need it around the 2% mark, but over the last 3 years, it has dramatically spiked. And when it comes to inflation targeting, policymakers have come back down and said over the next 6 months, we anticipate inflation to go down to X level. Okay, so it is one of the more widely used strategies by central banks worldwide in order to ensure price stability and really foster economic growth. So whenever we talk about the inflation target, as mentioned, it is 2%. It's always done as a percentage, but every region is going to be different. Now, the key for me is the communication and transparency. Now, inflation targeting requires the central bank as well as policymakers to be very clear and open about the goals and the methods used to achieve those goals. So regular communication with the public and markets ensures that everyone understands the central bank's objective and strategies. Okay, so when it comes to the transparency part, it really helps anchor our expectations. Policymakers will inform businesses and investors and consumers about the expected course of action. Okay, and so you can make your decisions based upon what they say. And it's normally through a press release, it's normally through reports or statements. This will help manage our own expectations. So I always say, look, looking at data is one thing, breaking down the facts and figures, that's all good, but it's also important about what individuals say. Policymakers, central bank heads, they are the ones that rely on transparency. They're not here to try shocking us or businesses. They need everyone on side in order to stop any form of seismic event occurring, like, oh, we wasn't informed of that sort of thing. So always keep an eye out on what people are saying. Again, you can look at your Forex calendar or your economic calendar, and you will see when policymakers are speaking. The next one will be operational independence. For any form of inflation targeting to be effective, the central bank needs operational independence from political influence. This means it makes its decision on interest rates and other monetary policy tools without the interference of the government. Remember, central bank and governments are two completely different entities. One don't work hand in hand. Yes, they communicate, but central banks won't make their decisions based upon what the government says. So independence really ensures that the decisions are made based on the economic data and the long-term objectives rather than short-term political pressures. So it enhances a lot of the credibility and the trust within the central bank in order to manage not only inflation but other objectives that it has. When it comes to instruments used, look, interest rates are the primary tool used for inflation targeting. Okay, adjusting rates, um, it's designed to influence economic activity. Higher rates, as we know, tends to reduce spending and investment. It cools down the economy, stops it from overheating, and in turn reduces inflation over a period of time. If you have lower rates, it does stimulate economic activity. It can help, the growth. But again, inflation will start to creep up. Okay, um, which is absolutely fine, especially if it's incredibly low. Um, lowering interest rates to get it back up to that 2% is fine. Okay, you will have open market operations. This is when the central banks will buy and sell government securities in the market to influence the amount of money that is actually circulating the economy. This can help guide inflation towards its target as well. Reserve requirements, changing the requirements for banks can affect the amount of money they are able to lend and indirectly influence inflation. Okay, reducing the reserve means that the banks now have more money to lend out. Okay, more people in the shops allow them to grow the economy. If you increase their reserve, in essence, they start tightening up on who they can lend to. There's less money in circulation. Finally, when it comes to forward guidance, central banks, as mentioned earlier, will use communicational tools in order to signal future policies and really shape market expectation and behaviors without any immediate action. You can, in essence, plan for months ahead. Finally, economic data. I'm a big fan of really understanding data. Not a lot of people use data, but if policymakers and central banks use data for their decision making, it's something we should be doing more often when it comes to making investment decisions. Okay, so inflation targeting relies heavily on analyzing economic data to make their decisions. Okay, so central banks will focus on not just CPI or PPI. Okay, it will look at GDP growth. It will help assess overall economic performance and whether the economy is running too hot or too cold. Unemployment rates, high levels of employment can signal, increasing wage pressures, which may lead to higher inflation. Exchange rate changes in the exchange rate can impact import prices and overall inflation. Okay, so these are the key areas that I tend to focus on, and it tends to be, if analyzed thoroughly and listen to the right policy makers, we can make informed decisions moving forward about whether we want to look to buy, whether we want to sell, or keep a more of a balanced portfolio. Finally, I'm just going to touch on uh, some of the key features with inflation targeting. One is obviously the clear goal. Always remember, understand, no matter what region you're in, here in the UK it's 2%. Understand what the goal is. It's a measurable target. Okay. Second of all, accountability. Central banks are held accountable for meeting inflation targets and must explain their policy decisions if they are to miss the target. There's a lot of pressure on central banks in order to keep the economy moving and in a growth stage. If they're taking too long lowering interest rates, it could send shivers through the market. Okay. Finally, flexibility. Inflation targeting frameworks are generally flexible. It does allow central banks to um, consider factors, wait on a lot of the economic data, um, especially when inflation is within an acceptable range. That they don't feel rushed to do anything. But remember, accountability for me is one of the main things, and I think that's where a lot of the pressure comes from the market. If the economy is struggling and inflation is at 2%, why are interest rates not coming down? It could be based on the fact that there's some headwinds in the future that we are not maybe seeing, but central banks are reading the data and potentially see something coming down the line. So you may want to evaluate and adjust your portfolio accordingly. Hopefully that's explained everything with regards to inflation targeting, and hope it helps. Okay, now, lender of last resort, in essence, is typically a central bank. It can be a government. The role is to provide emergency liquidity support to financial institutions that are facing a liquidity crisis or a seismic uh, disruption to their existence, okay, where they could see loss of jobs and it could have knock-on effects, okay, particularly within the financial system. You know, everything operates on confidence. Banks only hold a fraction of their deposit as liquid reserves, as the bulk of their money is tied up in long-term investments as well as loan. So if confidence does erode, that can have a knock-on effect. So when we look at why we need lender at last resort, one is obviously to provide financial stability. It's essential for maintaining overall stability, especially during market and financial turmoil. Liquidity shortages in one institution can trigger a cascade of failures across the financial system, leading to a broader economic crisis. So, acting as a lender of last resort, central banks can prevent individual liquidity issues, and that can potentially um, stop destabilizing an entire banking system. Okay. There could be illiquid banks. Banks often face mismatches between their short-term withdrawal demands of deposits and long-term loans that they provide. Even well-managed banks can become temporarily illiquid. Okay, if they don't have enough liquid assets to meet sudden demands, the LLL, or the lender of last resort, can provide banks with emergency funds in order to, bridge the gap, allow them to meet their short-term obligations without facing any type of insolvency moving forward. Confidence, as I mentioned earlier, in the financial system is big, okay? Especially in times of financial distress, rumors or fears about a bank insolvency can cause individuals to panic. We could see a bank run where large numbers of customers withdraw their funds simultaneously. So, being a lender of last resort, they can step in, reassure depositors and investors that the bank has sufficient liquidity to meet demands, and it helps restore confidence in the bank, knowing that the bank is not going to go under. It may stop me from going to the bank and taking out my pennies, for example. Okay, and as mentioned, preventing bank runs, we've already touched on it, so we don't need to go into too much detail. Um, it's just there to ensure that banks can continue to meet their obligations and stop the likes of you and I from having to go out and take all our money out. Now, when we look at examples of, central banks being a lender of last resort, the two prominent ones for me stand out will be the, '08 to 2010 recession, especially here in the UK, when the Bank of England had to step in and bail out the likes of RBS and Lloyd's. So the government, in essence, owned about 30 to 40% of Lloyd's, which the government has relinquished all its shares now, but I believe they still hold, a huge amount of shares within RBS. That was the first time I knew of lender of last resort. And then it was obviously during the pandemic where, in order to stop any form of bank runs, um, you know, central banks would step in and provide liquidity where needed in order to make sure that even there's no one working, the economy's slowing, there's no growth, that nothing was going under. So, lender of last resort, very common, but not used all too often. Okay, but it's important to keep a very close eye, especially if there has to be some form of intervention by central banks, and that could give us an indication of which way this economy may waver.